Hello, and welcome to the 2025 North Coast Ventures Annual Meeting. I'm Todd Fetterman, Managing Director of North Coast Ventures. We're recording from the offices of Thomson Hein, our longtime partner and sponsor of this year's event. We're thrilled to have record attendance tonight with more than 600 investors, startup founders, and members of the broader North Coast community. Your presence is a testament to the strong culture we've built together and the remarkable progress our portfolio companies have made over the past year. As we move through tonight's agenda, please keep in mind that we are regulated by the SEC. The information and opinions shared here tonight are intended to be educational in nature and should not be considered investment advice or an offer to invest in any securities. With that said, we're excited to share this update. We'll begin tonight with an overview of our funds, including highlights from our two newest vehicles, Acceleration Fund 3 and Seed Fund 5. Next, you'll hear 5-minute updates from the CEOs of 5 of our fastest growing companies, each offering an overview of their progress and momentum. We'll then review the broader portfolio and share select updates from individual companies. And to close the evening, I'll sit down for a fireside chat with Stewart Kohl, co-CEO of the Riverside company. We'll discuss the current investment landscape, the evolution of AI, and how Riverside partners with its portfolio companies to drive growth and value. Before we dive in, I'd like to share a few important thank yous. First, to our lead event sponsor, the law firm of Thomson Hein. Their New Ventures group is nationally recognized for its work with startups and venture funds, especially here in Northeast Ohio. They represent high-growth companies across technology, healthcare, and consumer products. We deeply appreciate their contributions to the startup ecosystem. I'd also like to thank North Coast's nearly 25 Innovation Council members. These organizations make many of our key activities possible. In particular, we'd like to thank the Ohio Third Frontier Program, which has provided nearly $40 million in investment capital across our portfolios. And finally, to the North Coast Ventures community of over 500 individual investors, we thank you. This group includes successful entrepreneurs, corporate leaders, and industry experts. Your support, engagement, and willingness to open your networks has been instrumental to our success. We're grateful for your commitment and the impact you continue to make. And with that, let's dive in. As a reminder, our investment thesis centers on software, typically business-to-business software-as-a-service companies. We focus on sectors such as digital health, healthcare IT, insurtech, and the future of work. Our team looks for high-potential companies that can benefit from the strength of our engaged investor model, where strategic capital is paired with access to market-making customers. We invest at 2 key stages, seed and acceleration. Seed stage companies typically have a small team, a minimum viable product that delivers on the core value proposition, and early customer traction. Acceleration stage companies have more established momentum, usually with recurring revenues between $1 million and $5 million. Our acceleration model enables us to continue backing many of the top-performing companies from our seed portfolios, especially those demonstrating significant commercial traction. Because we already have deep visibility into these businesses and strong relationships with the founder, the ability to deploy more capital as they grow is both strategic and compelling. As we reflect on the past year, several key milestones stand out. First, the exit of Amplifund. I'll share more details in a moment, but this exit was especially meaningful as it benefited 3 different North Coast funds and more than 180 of our individual investors. Second, the launch of 2 new funds, Acceleration Fund 3 and Seed Fund 5. Together, they represent the next chapter in North Coast growth, anchored by $15 million secured through a successful SSBCI program award through the state of Ohio. Third, strong portfolio momentum. Multiple companies hit significant revenue milestones, such as $10 million, $25 million, and even $100 million in annual revenue. One standout, Vitalize Health, was recognized as the fastest growing company in the country by the Inc. 5000. Fourth, we completed 9 new investments in 2025 across both seed and acceleration stages. Fifth, we expanded the North Coast team, welcoming Michael Leonard as a full-time investment associate. Michael comes to North Coast from Elevate Ventures in Indianapolis. And finally, we strengthened our systems to better support founders and portfolio companies. This includes building a new database that leverages CRM tools, AI, and other technologies to enable smarter matchmaking with subject matter experts and potential customers. This approach directly enabled the placement of more than 20 board directors and observers, as well as advisors across the portfolio. It's hard to overstate the quality and impact of these individuals. A few names that began new engagements in 2024 include Chris Beck, Jim Haas, Mike Linton, Jeff Tobin, Maya Hansen, and Nancy Tinsley. As we look back on 2024, it's clear this was another dynamic and defining year for innovation and growth. After the emergence of generative AI in 2023, this past year marked its full arrival, with expectations shifting rapidly. Tools like ChatGPT reached 100 million users in record time. Enterprise adoption is underway, and companies that lack a substantial AI strategy do so at their own peril. Underpinning AI developments is the rapid evolution of foundation models, which continue to improve in capability, efficiency, and specialization. As we look ahead, the emergence of agentic AI systems that can reason, plan, and act more autonomously is beginning to redefine how we think about productivity, decision-making, and even company composition. Through much of 2024, inflation continued to cool, and some of the more pessimistic economic forecasts began to ease. M&A activity, however, remained historically low, reflecting ongoing caution in the capital markets. Looking ahead, the transition to a new federal administration brings with it considerable uncertainty, particularly around trade policy and potential shifts in tariffs. While the full impact remains to be seen, we're watching these developments closely, working to support our companies in navigating an evolving economic landscape. Against this macro backdrop, North Coast portfolio companies collectively generated over $2 billion in revenue in 2024, with 10 companies surpassing the $10 million mark. And despite a challenging fundraising environment, more than 20 companies raised capital, underscoring the quality of the teams, products, and market opportunities across our portfolio. As we look ahead to 2025, and with our group now at over 500 individual investors, we are the largest group of our kind in the nation, and we are looking forward to doubling down on our commitment to making introductions of value. This is where North Coast facilitates a meaningful connection, introducing a portfolio company to a potential customer, investor, or strategic partner. These introductions create momentum, unlock opportunities, and accelerate growth. In 2024, our team documented more than 200 introductions of value, resulting in millions of dollars in incremental sales and tens of millions of dollars in total value creation across the portfolio. In 2025, we're building on that foundation with new tools and systems to help us scale this capability even further. We're enhancing the rigor of our HubSpot database, better documenting key relationships, and using AI to more intelligently map and activate our network. With this backdrop, we have high expectations for 2025, and we look forward to working alongside our investors and portfolio companies to make it happen. Next, I'm excited to announce this year's North Coast Ventures Member of the Year. This award honors individuals who go above and beyond in supporting our fund, our portfolio companies, and the broader startup ecosystem. This year, we're recognizing two individuals who have made extraordinary contributions to our community, Ted Frank and Mitch Kroll. Ted is a former CFO of CoverMyMeds, one of Ohio's most successful tech exits, and has brought tremendous experience, generosity, and strategic insight to several of our portfolio companies. Most recently, he agreed to chair the board of Preos Health, helping guide the company through its next phase of growth. Ted has been instrumental in helping our team evaluate opportunities and strengthen our approach to scale stage growth. Mitch is the founder and CEO of Findaway, a Cleveland-based world-class audiobook company acquired by Spotify. He not only built and led a global business, but has also leaned in with North Coast and our startups, offering coaching, candid feedback, and connections that have opened valuable doors. With Mitch's leadership, we have begun to roll out a new CEO coaching program to our portfolio companies that we believe has the ability to drive tremendous impact for our founders. We're in the process of facilitating connections between our portfolio company leaders and founder coaches from our LP base. Mitch is partnering with us to be our lead and primary coach or captain of this coaching program as it is launched. We're incredibly grateful to Ted and Mitch for their time, wisdom, and continued involvement, and we're proud to recognize them as the 2024 Members of the Year. Before shifting to 2025's investment activity, I want to take a moment to highlight the exit of Amplifund. This was one of our earliest B2B SaaS investments and a powerful example of what can happen when visionary founders, experienced operators, and supportive investors work together in sync. The company was founded on the deep domain expertise of Adam Roth, who understood the complexities of government grant management and saw a better way to navigate them. Over time, he and his team translated that insight into a powerful software platform now used by public sector organizations nationwide. As the company grew and established momentum, we invested a total of more than $3 million across our seed fund and 2 acceleration funds. For one of those funds, Amplifund became our single largest investment and ultimately returned over half of that fund. I had the privilege of serving on the board from day one, supporting the company through early traction, scaling challenges, leadership transitions, and ultimately a successful sale to Unisystems. In a challenging market environment, this exit is a meaningful win for the Amplifund team, for North Coast investors, and for the broader regional ecosystem we're helping to grow. With that, I'm pleased to pass the baton to Daniel, who will talk about our fund's investment activities.
Thanks, Todd. And thank you to all of our members, founders, co-investors, and extended North Coast Ventures network for joining us today. I'm Daniel Luketic, a partner at North Coast Ventures, leading our investment and portfolio support operations. And I'm excited to summarize our investment activity and portfolio headlines from the past year. As you heard earlier, we are always focused on facilitating introductions of value between our network and our portfolio companies. Please don't hesitate to reach out to our team if you have a connection to a prospective customer or partner of any of these portfolio companies we are about to discuss. Last year, we completed 7 initial investments in companies that are new to the Seed 4 portfolio, deploying over $1.5 million into these companies. We have now completed all of our initial investments for Seed 4. I would like to briefly introduce the new portfolio companies now, starting with Ready. We invested in the company's $12 million Series B round led by Blue Heron Capital at the beginning of the year. Ready helps pharmaceutical companies improve patient enrollment, adherence, and persistence in treatment. The company nearly tripled contracted annual recurring revenue last year, and over 100% growth is anticipated in 2025. Exploro is a healthcare technology company focused on transforming pediatric patient education. Exploro has established an impressive early customer base of many of the leading children's hospitals. Helia is a Y Combinator-backed company offering an AI-powered tool to help companies reduce healthcare costs by optimizing employee benefit selection. Helia has grown annual recurring revenue by over 7x since our investment. After our initial investment in Preos in March of last year, NCV recently led the company's subsequent seed round. Preos is a healthcare staffing software platform that streamlines the hiring process through recruitment automation. The company grew from 3 customers to over 30 in 2024. OnStation is a Cleveland-based B2B software company offering a digital stationing platform to the road construction industry. ARR grew by over 57% as the company has established itself as an emerging market leader in digital stationing. Finally, our 2 most recent investments were in OneLogTech and Beatomic. We led the investment round in OneLogTech, a platform that enables shippers, third-party logistics providers, and carriers to integrate operations seamlessly. Beatomic has developed Neon, which provides independent insurance agencies the industry's first third-party agency management system connected service center. We also completed initial investments in companies that are new to the syndication and acceleration 3 portfolios. We deployed $250,000 into Givzey and $500,000 into Uptime Health. The CEOs of each of these companies will present updates on their growth shortly. Finally, we completed follow-on investments in these 14 portfolio companies across the Seed 3, 4, Syndication, Acceleration 1, and 2 portfolios. We deployed nearly $4 million via second and third checks in these companies. And so after another active year that saw us make over 30 individual investments, here's a summary of our active portfolios. To date, we have deployed over $100 million into more than 80 companies. Our management team and members that serve as board representatives and advisors are working closely with these active companies to drive growth and an eventual exit. With that, I am excited to introduce a handful of our portfolio company CEOs that will share brief presentations. The first company presenter, Mark Abbott, is the founder and CEO of 90, a syndication fund company.
Hi, I'm Mark Abbott, founder and CEO of 90. So what's 90? We're a company that's dedicated to giving ambitious leaders everything they need to confidently navigate the great company building journey. We were founded in 2016, and we currently serve over 15,000 organizations and 1 million employees. We serve by giving our clients access to the essential concepts, tools, discipline, data, and support they need to confidently navigate what we refer to as the unavoidable stages of development associated with building a great company. Our 170-person plus strong team loves giving leaders everything they need to build great organizations where employees are focused, aligned, and thriving, because we deeply believe work shouldn't suck. So how do we do this? First of all, we get all of our clients to understand they have an operating system, and that if they really want to be efficient and effective in terms of navigating the stages of development, they need to all get on the same page, use the same operating system. Otherwise, it's basically tech tax tyranny, and you have an organization with a bunch of different departments doing a bunch of different things. What ultimately happens is sooner or later, founders and CEOs find themselves needing to upgrade their business operating system. 90 supports many of the best-in-class business operating systems like EOS, but we recently rolled out the 90 Way, which is our proprietary and totally free collection of every one of the concepts, tools, and disciplines and assessments leaders need to confidently navigate what we call the unavoidable stages of development. So what are those unavoidable stages of development? Well, basically there are 5. It's start, build, grow, scale, and exit. And exit basically means you can transition leadership to another CEO, you can sell the business, or the business is ready for going public. How do we do this? We give them, as I mentioned earlier, the essential tools and disciplines they need. And you can see on this slide, if you want to, you can pause. We have a lot of tools, meetings tools, goal development tools, assessments, KPI, dashboards, everything you really need to understand where you are, what's important, and what do you need to be pretty damn good at next. As an example, you do not need to be great at leadership and development training until stage 4. All right, so how are we doing? We grew the company about 40% in terms of ARR last year, did the same thing on paying users. Net revenue retention was down. We did not do a price increase. If we had done the same price increases the year before, it would have been up slightly, and paying companies is up over 37%. In terms of our metrics, you can see these here if you want to pause, but basically we've been growing at 80% plus up until last year. I believe we can get back to 50%. For this year, we're shooting for 40%, but I'm taking the over on it. In terms of the revenue, we have revenues coming from our coaches. Those are called, a lot of them are EOS implementers, and those are EOSIs. About 13 million of our revenue comes from them. Just organic, being known within the EOS workspace, is about 10 million of our revenue. Other coaches have brought in about 7 million of our revenue. Paid has brought in about 2 million of our revenue, and we're getting a bunch of different companies to start running on 90, and that represents almost 2 million of our revenue as well. Goals for the year, as I mentioned earlier, to grow 40% in terms of ARR. I believe we're going to beat that. So I'll take the bet on that one. And we're going to get our burn ratio down less than 1. CAC payback period shows 13.7. You can read all this. I think we're going to beat a number of these numbers. Goals for the year. One of the things that we deeply believe we can do better is get everybody in the company on the platform and using the platform, hopefully almost on a daily basis. And there's a bunch of initiatives underway. There's product enhancements underway. There's new tools coming out this year that'll help us hopefully get product market fit for the whole company. And in addition to that, we're changing our pricing model. We call it the new commercial model launch. And we're going from basically price per seat to a freemium good, better, best, which also will hopefully help us get more and more of our clients' employees on the platform. So that's the story for the goals for the year. In case you don't know, our ICP is basically small and mid-sized businesses historically, typically companies with 10 to 250 employees. We focus on getting in front of and making a compelling argument to the founders and or integrators of those organizations, chief operating officers, and as an example. And we're entirely industry agnostic. Our largest industry concentration's around 10 or 11%. We are starting to do work on getting more and more, just getting stronger in terms of the enterprise world. We need to do services in order to support that. We need a sales organization. We don't have one. So these are initiatives that are underway right now. And then we also have increasing amount of great relationships with private equity firms, venture capital firms, and franchisors, and their affiliated companies. Our paying companies are typically used to grow at 20% for what it's worth. Lately, they've been pretty flat, only growing at 4% versus down, generally speaking, in terms of number of employees across the country. One of the things you should know is our annual churn rate is less than 1% if people take advantage of the entire platform. We're extraordinarily appreciative of North Coast Ventures and some of its portfolio companies that are running on 90. And really, that's my story. We're here to help people build great companies. We don't believe it's that complicated. And we also believe people make it much harder than it should be. So if you'd love to help us, help you, help the world create better companies, we'd love you to spread the word about 90 to ambitious founders, leaders, or anyone who genuinely cares about reducing the grind associated with building a great business. Thanks. Appreciate you all. Mark.
Thank you, Mark. Next up is Bloomfilter, a Seed 4 portfolio company led by co-founder and CEO Erik Severinghaus.
North Coast Ventures. Erik Severinghaus here, the co-founder and the co-CEO of Bloomfilter. Thank you so much for giving me the opportunity to address your national meeting. This is an unbelievably exciting time for us. We just finished up an unbelievable fiscal year. I'll tell you a little bit more about that in a second and give you some of the highlights. And I can tell you without question that we would not be here without the help and support from North Coast. So again, I want to start by saying thank you. We really appreciate it. Now, this is kind of a full circle moment for us. Many of you guys may recall, many of you were sitting in the room when we first started talking about the idea and the vision for Bloomfilter. We had this thesis that software development was broken. We knew that 78% of software was late, over budget, or not shipping at all. And we also knew the problem was pervasive. When you think about it, every company is a software company these days. Now, the third thing that was really kind of the novel part about Bloomfilter was the hypothesis that process mining, creating a category around process mining for the software development lifecycle, could be transformative and could absolutely change the face of this industry. It was a little bit of a new idea, but North Coast got it very quickly. In fact, there was a super strong process analytics guy by the name of Sam Aborn, who was one of the first folks that we met that really understood and got the thesis. He asked us some of the hardest questions that we'd ever gotten, but boy, did we learn and develop as a result of some of the stuff that he said. And by the end of some of those conversations, what we all agreed on was there was a huge opportunity for a company to be like Celonis, the undisputed leader of process intelligence, but take that concept and apply it to how software gets built. Fundamentally, that's what we wanted to do with Bloomfilter, is we wanted to be Celonis for the SDLC. In fact, that was even in some of our early pitch decks. Now, along the way, artificial intelligence has evolved very rapidly, creating or exacerbating the problem of the importance of process intelligence for software development, and also giving us all kinds of new tools to bring to bear in the solution. It's made it an unbelievably exciting time for Bloomfilter, and now Bloomfilter.ai. Now, the cool thing, this past year has been absolutely transformative, and we have largely proved out those theses, at least at the early stages. Our revenue is scaling very quickly. We're soon going to eclipse that magical $1 million mark, and it's starting to grow very, very fast, both as a result of some of our internal efforts and also many of our channel efforts, where we're powering partner solutions with folks like SoftServe and their DevIQ offering, and also now Celonis, where we power Celonis for the software development lifecycle. These things are starting to hit on all cylinders, and the pipeline ahead of us is absolutely huge. Now, most importantly, over the course of this past year, as we've shipped rapidly accelerating improvements to our product, we are seeing our customers get tremendous value. And in fact, many of our customer champions are getting promoted within their organizations. And as their remit grows, largely on the back of the analytics and the intelligence that they're able to bring because of Bloomfilter, we are able to grow our presence inside all kinds of large marquee accounts. Places like Bill.com, places like Home Depot, places like Chipotle. and a huge variety of others. Now, as I mentioned, we would not be here without North Coast, and we could not be more appreciative for what you guys have done. Mark Woodka on our board is not always the easiest guy to deliver tough news to, but I learn every day because of him and very much appreciate it. That process genius that challenged us so much from the very beginning, Sam Aborn, well, he is now one of the most important members of our team, helping us land some of the largest companies in the world and apply this process intelligence to their software development lifecycle. And Todd Fetterman, well, I'm hearing from Kevin, my VP of sales, that we may be trying to hire Todd because he's one of the most productive guys that we have in terms of helping connect us into new customers. We've been able to get a great new customer, largely on the back of North Coast introduction. Thank you, NaviStone. And because of North Coast, we're talking to places like Cardinal Health and Progressive Insurance, Medical Mutual, MRI Software, and a variety of other ones. So you guys have really been transformative for us in the journey. Like I said, this has been an unbelievable year. The year ahead is looking like it's going to be even way more fun as the product continues to grow and scale. Our go-to-market motions continue to mature. The channels continue to really blow out. And hopefully I'll have the honor of addressing you guys again and be able to tell you even more of the good news as it's coming our way. Once again, North Coast, thank you so much.
Thank you, Erik. Next, I would like to invite Larry Kavanagh, the CEO of NaviStone, to share more about their growth in 2024. NaviStone is a Seed 3, Acceleration 1, and Acceleration 2 portfolio company.
Hello, members of North Coast Venture Fund. I'm Larry Kavanagh, CEO and co-founder of NaviStone. I last presented to you 2 years ago. NaviStone has made a lot of progress since then. I'm looking forward to updating you on our changes. First, who NaviStone is has evolved in the marketplace since we last spoke. Our original focus was helping brands send physical postcards to unknown visitors on their website. It was a new concept in the marketplace when we started, and we hold 2 patents on it. Today, our platform helps brands with new customer acquisition, customer retention and reactivation, and marketing optimization across all stages of the customer journey. We still offer postal retargeting and have added 3 other products. We help brands reach customers and prospects that their existing marketing completely misses. We've expanded activation to include digital display as well as email. These product extensions have allowed us to increase the average revenue that a brand spends with us by more than 25%. Second, we've focused our direct-to-brand business on 5 verticals: travel and leisure, retail, beauty and wellness, apparel and accessories, and home services. On our website, we use the language that the CMOs in each of these verticals use when they're talking to their customers. For example, in travel, we say things like, fill your rooms and cabins. Effortlessly connect with new and past guests when they are researching their next vacation. NaviStone's platform lowers your cost per booking and fills your unsold inventory. Now, you may have noticed from this pretty website that you're seeing that we have completely refreshed our look and feel, as well as our language, to show our complete product line and our new vertical-specific positioning. Third, in 2024, we were honored to make Cincinnati's list for the fastest-growing private companies, as well as become a finalist for Best Places to Work. We expect revenue growth to continue to be strong this year. Our Q1 is on track to be our strongest quarter in history. For this year in 2025, we're expecting growth to be around 30% year over year. Fourth, we had both positive EBITDA and positive cash flow. That's been true since the middle of 2023. This has allowed us to fund growth internally and makes us a more valuable business in the marketplace. So what's coming next? I'll mention 2 things. In the next 30 days, we are launching a new go-to-market strategy. Historically, we've always sold directly to brands. We know, though, that many brands actually use agencies of record, or AORs, to run a lot of their marketing and as a source for their new ideas on how they're going to grow their business. So we've spent the last year building out our capabilities so that we can partner with these agencies of record and offer NaviStone products with them, either on a co-branded basis or a white label basis. We've identified mid-sized performance marketing agencies as a starting place. Marcus Thomas, an agency that was introduced to us by North Coast, is a good example. I have on this slide similar agencies that, if you know anyone at one of these agencies, would love an introduction. Second, we are talking to a large data provider about co-developing enhancements to our products. We are just beginning to explore partnerships with other complementary platforms. This could become an important growth strategy for us, but we're really just at the beginning of this idea. Thank you very much for the opportunity to present and all of the help that you've provided, both in terms of investment and by introducing us to new customers. We're at an exciting point in our business growth, and North Coast is an important part of our success. Thanks again.
Thank you, Larry. Next, we have a more recent addition to our NCV portfolio, Givzey. I would like to invite Adam Martel, serial entrepreneur and founder of this syndication fund company, to introduce you all to their solution, which is driving a huge impact in the nonprofit fundraising market.
Hi, folks. My name's Adam Martel, and I'm the founder and CEO here at Givzey. I couldn't be more excited to tell you about all the progress we've made over the past year with your support. Givzey is a nonprofit technology company focused on inventing the bleeding edge of nonprofit technology, and we couldn't be more excited to work in this space. My team and I have spent the past 10 years trying to figure out exactly what was next in the nonprofit technology space, and we're so proud to have the opportunity to work in this world-changing community, because these organizations, large nonprofits, they are truly the organizations that support some of the largest and most impactful world-changing missions, and we couldn't be more grateful for your partnership as we try to make a difference in the world. Now, the nonprofit space is amazingly big. There's 1.8 million nonprofits in the United States. These nonprofits represent and raised over $550 billion in 2024, and 83% of the largest nonprofits cite a labor shortage as their biggest concern over the next 3 years. And when you think about our market and the customers that we serve, we only serve the top 21,000 nonprofits in the United States. These are nonprofits that have frontline fundraisers that raise money at an amazing scale. And these nonprofits are really doing some of the greatest and most impactful work in our communities. Now, we have two products that we serve to the nonprofit community. The first product is our digital gift agreement platform. This product is an amazing evolution of past processes where donors who wanted to make a 3 to 5 year commitment to any nonprofit organization had to either go through a process where they had to sign a piece of paper and then have the organization spend thousands of dollars administering that pledge over the next 3 to 5 years, or donors wouldn't be allowed to make multi-year commitments at all. The digital gift agreement platform revolutionizes this process and allows nonprofit organizations to electronically accept gift agreements and digitally manage these gift agreements over a 3 to 5 year period, lowering the administration costs for every nonprofit organization. And the success of these nonprofits over the past year and a half, 2 years, has been amazing as they've implemented a digital gift agreement platform with over $340 million of gift agreements being passed through the digital gift agreement platform. This includes $38 million gifts that were made and executed on the gift agreement platform, and one $10 million gift that was executed and administered on the digital gift agreement platform. And over the next year, we think there's going to be over $1 billion of gift agreements that pass through the digital gift agreement platform. And we couldn't be more excited about the progress and the potential for this product as it continues to revolutionize the multi-year agreement process that donors go through when they make gifts to nonprofit organizations. Now, the second product that we have is truly revolutionary in category creating. This product is called Version 2, and this product reinvents what's possible at nonprofit organizations by allowing nonprofit organizations to use the first fully autonomous frontline fundraiser to build relationships with donors and close revenue for nonprofit organizations. Now, the exact and specific problem that we're solving for these nonprofits with Version 2 is pretty simple. There's a labor shortage of frontline fundraisers at nonprofit organizations, specifically because frontline fundraisers don't go to school to be fundraisers. So at every nonprofit organization, whether you're the largest or the smallest, it pretty much looks the same in proportion. So if you take an organization like the University of Toledo, they have 170,000 living alumni. And only 4,000 of these living alumni are managed by a handful of frontline fundraisers, which means that there's about 15,000 living alumni that aren't managed by frontline fundraisers at all. And this is why autonomous fundraising is so important. Our mission at version 2 is simple. We want to build the world's most experienced frontline fundraiser using autonomous artificial intelligence and offer the ability to add trusted digital fundraising capacity to every nonprofit organization in the United States. And over the past 6 months, we've done just that with 40 of the United States and the country's largest and most impactful nonprofits adding digital labor and virtual engagement officers to their staffs. Let me introduce you to Lauren, who is a virtual engagement officer at Bucknell. Lauren's been on the job for 4 months, managing about 1,000 donors and building relationships with these donors. And Lauren's raised over $228,000 for Bucknell in just the 4 months that she's been working. Parkland Health introduced Nicole to their communities, and Nicole's raised over $100,000 over the past 3 months for Parkland Health's community to help the organization raise more money for burn victims and emergency room patients. And Parkland Health is reinventing the grateful patient community. Our belief is that over the next 5 years, digital labor will play a role in every nonprofit organization's fundraising efforts. And we couldn't be more excited to create this category and lead it, as we think it will define the space. Now, transitioning over to the business side of our organization, North Coast Ventures invested in the second portion of our seed round back in 2024. And the point and purpose of that seed round was to help our team accelerate growth to over $10 million in ARR, help us achieve over 110% net revenue retention, and put us on a path to profitability so that we can continue to expand the work creating the category of autonomous fundraising. And I'm so excited to announce that back in Q4 of 2024, we closed our very first $1 million quarter. In this quarter, Q1 of 2025, we already have $1 million committed against our $1.2 million goal for the quarter, which is just extraordinary growth for a team like ours. We're doing about $3.2 million in ARR, and as you can see, we're on a path to $8 million by the end of the year and $10 million very soon, which is the high watermark that our team wanted to hit. And speaking of our team, we have a world-class team doing the very best work of their life and operating at an amazingly high level. And our team supported by a board that believes the vision that we believe and sees the future that we see, where digital labor sits next to traditional labor at these nonprofit organizations. So I want to end by saying thank you to the North Coast Venture community. We couldn't be more grateful for your continued and loyal support as we work to change the world. It truly is with your support that our technology allows these nonprofit organizations to accelerate their missions and achieve things that they never thought were possible before. And we're so grateful to be on this journey together. Thank you again for your support.
Thank you, Adam. Finally, Jinesh Patel, the CEO of Uptime Health, will share an update. Uptime is a syndication fund company and the first investment completed from our new Acceleration 3 portfolio.
I'm one of the co-founders and the CEO of Uptime Health. At Uptime Health, we provide a software tool for healthcare providers to effectively manage the equipment they use to take care of their patients. We see equipment as an important part of the healthcare delivery system. Without quality equipment and it being calibrated and up and running, you can't effectively provide quality care or care at all without the equipment. So we make sure it's up and running at all times at a reduced cost and as quality as humanly possible, so we all get the best care possible. Today, a lot of these smaller outpatient clinics, such as urgent care, dental offices, and optometry offices, don't actually have people like me, who's a biomedical engineer, on site to give them the best practices on how to take care of their stuff, or even provide guidance on when to replace it instead of repairing it next time. What we've done is we've created a tool that tells them what they own, based on what they own, how can they effectively manage it, and if it breaks down, we have a services marketplace that they can engage with to get repairs done. And we provide a business model that creates a software solution SaaS fee, as well as a marketplace take rate for services, equipment, and parts that are provided as part of the fix event. Over time, especially through 2024, we're also working to integrate directly with the machine. So if they can self-alert that there's errors or issues happening, then we can proactively dispatch people with the right tools or parts in hand, depending on the error code. So it's a first-time fix and everyone's back up and running. Because we know Every down hour in an office, like an urgent care dental office, is an hour, one, a patient's not getting seen, but also an hour that that practice is not providing and creating revenue. So everybody in the delivery system hurts. Now let's get into traction. 2024 was an amazing year. We had our best quarter to date in Q4, where we generated $4.4 million in top line revenue throughout the quarter. That was a blend of services and SaaS. We ended at a SaaS run rate of 1.8 million ARR, and we expect that to grow another 2 to 3x here in 2025. And we also did a ton of service revenue, as you can imagine, where the makeup of that 4.4 came from. The remainder was services. That was because in 2024, we also acquired a company called Dental Whale, which activated us to be able to service equipment in the dental space through our own marketplace. It allows us to sell parts to those technicians. So now we can have a parts revenue stream as part of the service, and also allowed us to sell equipment for equipment that could not actually be effectively repaired that we could replace because now we have the distribution lines. That acquisition unlocked a lot of revenue and a lot of potential for this company that we're planning to expand upon here, not just in 2025, but years beyond. We grew our top line 10x year over year. 2023, we ended just over $1 million. 2024, we ended 11.5 million top line revenue. And again, we expect 2025 to generate close to 17 to 18 million top line because we do see another growth year with a lot of the leverage of the new acquisition, as well as the good learnings that we had throughout 2024. And speaking of 2025, we already have enough amazing earlier momentum. We have signed a partnership with Patterson where they gave us a $500,000 prepayment as part of the partnership negotiation. This helps them put skin in the game to activate their ability to sell our licenses quicker. That means today, because we signed Patterson early this year in January, we now have Henry Schein, Darby, and Patterson, and we're working on Benco. But the other three are three of the top 4 distributors in the dental space, which are now effectively pushing our solution, and we should reap some of that benefit here in 2025. Also, not publicly announced yet, but we were named to the 2025 Most Innovative Companies list for Fast Company. We love that because it shows to me and my team how much we've effectively grown and made a difference in these spaces where equipment management has always been an afterthought, where usually it's about patient workflow and provider workflow. We're all about equipment workflow. And I think that's just another change in how people think about how they run their operations that we're helping create and move on our own. Now, if you look at this bar chart, you'll also see our sales did a great job in 2024, not just from a revenue perspective, but we started the year with 953 locations and ended the year with 1,800 locations. So we doubled the location count. We also changed over our leadership. So we have a new CRO, we have a new VP of equipment, a new VP of SaaS. We now have bundle offerings where we can sell service plus our software as a combined offering. All these things are really going to fuel our 2025 catapult. And lastly, in terms of just traction, we've increased our coverage map in the dental space, not just through the acquisition, but through other efforts. Today, we're in all but about 5 states. We even have Hawaii, where we have 5 technicians out there. And our goal this year is to expand and not just cover all states throughout the United States, but continue to create density to build the best effective service map that the nation has ever seen for the dental world. Now, as we look at how we can help and kind of things that we're looking to do and achieve as this company, is we're looking at the market headwinds. Although we can manage all types of outpatient, including urgent care, veterinary, optometry, dental continues to have interesting market headwinds where we don't want to really move away from it. They're expected to grow significantly. We see major distributors like the Scheins, Pattersons, and Darby struggling, which is why they're engaging with us to create another solution they can offer to their client base, but also manufacturers looking to sell direct. Before us, they've always had to go through distributors where they're also the service arm, and therefore the manufacturers never had a service arm. And at Uptime Health with our marketplace, that service arm's for anybody. Not just a doctor, but also manufacturers. So we're helping them unlock a way to go direct for the first time. And this is going to be something that is going to continue to position us as a very important player in this dental market. For Ask, one, any client introductions, we're looking for outpatient locations, whether dental is, again, our focus, but we do urgent care, surgical centers, veterinary practices, optometry practices. As long as you have a few locations, call it 5 or more, you're a pretty ideal client for us because it's really hard to manage your equipment that way. The last ask I have is for AI experts in the audience. We've been toying with AI a lot, not just through our product, but we know that there's so many tools out there that are going to help operationally make us more efficient that we might not have even seen yet. So if there's anyone who has seen one of their companies or portcos really effectively use AI to increase their operational efficiencies, please let us know. We're trying to make sure that we're continuing to put that at the forefront of our company to increase not just our margin, but our ability to scale with less revenue. Thank you for your time, and thank you again for allowing us to be a North Coast Venture portfolio company. I'm looking forward to this year, and I hope you have a great meeting.
Thank you, Jinesh. Now let's move on to headlines from the broader portfolio over the past year. We have a number of other portfolio companies that appear to be on the path to a successful exit. I'll share brief headlines related to a handful that we are really excited about. Starting with Vitalize. In August, it was announced that Vitalize was the #1 company on this year's Inc. 5000, making it America's fastest growing company based on its 3-year growth rate. In the Inc. listing, they cited over $1 billion in revenue for 2023 and a 3-year revenue growth of over 90,000%. Vitalize transitions primary care practices to value-based healthcare by combining technology, financial incentives, and virtual and home-based support to drive practice transformation. Next is Society Brands. This company is an e-commerce aggregator with a unique technology and acquisition strategy. Through Q4 of last year, the company completed 13 acquisitions with over $140 million in annualized run rate revenue and over $15 million in asset level EBITDA. Formotive is a Philadelphia-based software company that provides leading insurance carriers actionable insight into the truthfulness and intent of their digital applicants. The company grew ARR to $7.6 million across 14 customers last year. Actual ended the year with ARR over $10 million, up 72% from the previous year. Actual is a workforce intelligence company powered by a national real-time practitioner data network. Notably, their network now consists of 19,000 primary sources and 19 billion claims, representing 1.1 million practitioners nationwide. This was a significant year for ReadySet Surgical, which provides cloud-based solutions for hospital and surgery center supply chain and surgical staff. They closed 9 new customers to end Q4 with ARR of $3.3 million, which is up nearly 70% year over year. Here locally, the Cleveland Clinic main campus went live in mid-September. Finally, CloverPop added even more well-known brands to their customer list in 2024, ending the year with over $3.5 million of ARR, which was up 89% from last year. The Chicago-based decision intelligence platform combines the power of human and artificial intelligence to help companies make better and faster decisions. Gartner recently forecasted significant growth into decision intelligence adoption, noting that by 2026, 75% of Global 500 companies are predicted to apply decision intelligence practices. As I wrap up with our portfolio headlines, I would like to remind our investor members that a detailed report, including a chart like the one shown here, along with a written narrative about the progress and significant updates related to each portfolio company, can be found in our member portal. This example chart shows the overall composition and performance of one of our portfolios. Now I will turn the program back over to Todd, who will lead a fireside chat with Stewart Kohl.
Well, thanks, Daniel. I am here on the 57th floor of Key Tower in the brand new Cleveland offices of the Riverside Company. And I am pleased to welcome Stewart Kohl as our fireside chat guest. Stewart is the co-CEO of Riverside, a global private equity fund that has invested over 35 years to help grow and support companies. Beyond private equity, Stewart is deeply involved in philanthropy and the Cleveland business community. His expertise in working with management companies to help drive growth and create long-lasting value is part of what makes him one of the most respected leaders in private equity today. And just as importantly, Stewart is one of North Coast Ventures' individual investors. Stewart, welcome.
Thank you, Todd. Pleasure.
Absolutely. Well, it is great to have you with us. It is great to have you with us as an investor in early stage and growth companies, as an investor in North Coast, and as someone who sees the general private landscape overall. It's been a eventful past several years, to say the least. We've had COVID, partial return to office, increases in inflation, increases in interest rates, and the emergence of AI, which is clearly, in the very near term, going to be profoundly impacting not just the work world, but also the private world. So there's a lot of moving parts, but for the most part, private equity has remained a pretty stable fixture in overall capital structure. So I'm curious to get your sense, as somebody who's lived in this for decades and also seen many different economic cycles, where you think we are relative to the health of PE.
Yeah. First of all, great to be with you, and thank you for that. Look, I love PE, and I think it's been a great place to be for 35 years, and I'm fundamentally optimistic that it will be a great place to be for another 35 years, and perhaps we can talk about why that would be. But I don't want to minimize the import of what you're saying. We went from, once upon a time, there was the normal, remember those days? And then we had the new normal.
Yeah.
So now I have heard it said we're in the no normal, that things change so much, so rapidly, that we have to sort of get that out of our mind and instead stay on our toes and be agile and recognize that things are changing all the time. But private equity has benefited from the fact that what really makes private equity work, if you will, is getting the alignment of interests right. Getting everybody from our investors through Riverside, through the CEOs of our companies, down through the C-suite, and increasingly we're now pushing that down all the way through the organization, even down to the shop floor. Getting the right set of incentives and rewards so that we're all aligned. And once we do that, it's if you watch rowing, when everybody is rowing together, the boat almost shoots forward, and that's what happens at the best of our companies when we get the alignment right. So that's why I'm so high on private equity.
And outside of focusing on alignment in the current environment, are there any things you're doing differently in terms of evaluating risk differently or evaluating even the general thesis of what kinds of companies you want to support?
We need to pay a lot of attention to the macro. We are at Riverside, we're really micro investors. I mean, at the end of the day, we invest in a company because it's a good to great company in an excellent industry where we have a very tangible, concrete idea for how we could double or triple the size of the business, professionalize the business, and make it worth more. And once upon a time, we maybe pretended we could do that, and if you just focused on the company, everything else would take care of itself. But today, so much is changing: government, capital markets, the economy, global. So we do have to be smarter about the macro, and that's a challenge for people like me who got spoiled. But we are paying more attention to the macro than ever before.
Okay, terrific. And from a venture capital perspective, it's been really interesting to watch the increasing interest that private equity and growth equity has taken into the software world.
Yeah.
We've seen it broadly, but also specifically within our portfolios with businesses like Wiser, Able, and now recently Amplifund selling either to private equity directly or to private equity sponsored companies. So I'm curious, as you, having run a portion of your fund investing in technology and SaaS for the last 10 years and looked at this, what do you think about that as a specific asset class today and what you're seeing?
Yeah, so let me just quantify for a moment. SaaS is our number one vertical, if you will. We've invested in about 150 SaaS businesses. We've deployed about $1.5 billion in it. And it's performed exceedingly well. Not every company every day, but it's performed extremely well. I remain very high on the opportunity, if you will, but I recognize that it's a much more mature asset class today than it was when we started investing in it decades ago. But we still invest in very young SaaS businesses. We invest in middle-aged SaaS businesses. We don't invest so much in fully mature SaaS businesses because of our focus on the smaller end of the middle market. And I believe that we can make money at any one of those stages if we're backing the right team with the right product, in the right with the right macro, the right industry, the right tailwinds, if you will. I think all of us who have been active in it need to recognize that we went through a very special period in 2021, and it was in a way too good to be true.
It was.
And when we were selling, it was amazing, and when we were buying, we probably paid more than we should have. And that was an anomaly. The market then overcorrected after interest rates spiked and the world changed in 2022. I believe that water is now finding its level and that valuations are more normal. Not to say we'll never have a bubble again, but it will be some time because the bubble created a lot of wealth, but it also destroyed a lot of wealth.
Certainly. We've certainly seen that in our portfolio, and having gone out recently with investment banker for the transaction for one of our companies, we've seen a much healthier ecosystem overall, which was comforting, maybe not a return to normal, but a newer normal level of interest across both the strategics and the financial buyers.
When we invest in a young SaaS business, as we do with our particularly Riverside Acceleration Capital, we're always looking at its ability to grow its ARR. They're pretty much going to use our proceeds to buy ARR, if you will. And you can see how that fundamentally makes sense. As the companies mature, and particularly with our other funds, where we now start to be not just an investor in its growth, but a controlling owner, we're always buying businesses with an economic model that says maybe we're paying a multiple of ARR today, but the valuation is going to make sense based on a discounted cash flow and ultimately a multiple of EBITDA, like a quote unquote normal business. So I think that's very healthy for the industry, and it's a discipline. So the folks that are running your software businesses should always be thinking about, do we have a business model that maybe you have to go out 5 years, maybe you have to make a lot of assumptions, but will produce an attractive valuation on a traditional discounted cash flow basis.
Okay. And let's dig in there for a moment, because invariably it's a lot easier to put money into a company than it is to get money out.
Yes, it is.
And as Riverside works with these early and some cases slightly more mature SaaS startups, there's going to be an opportunity for exits at multiple points to both financial buyers and strategic buyers. So I'm curious how you think about the path that they're on and how that might impact some decisions along the way.
So we're always invest with a case, if you will, and then we are monitoring progress against that case. We go in typically with an idea for what it might look like at exit, but our crystal ball is no more perfect than yours or others, and we don't always get that right. But we do have a plan that we're working against, and I talked about the importance of alignment. So it's not our plan; it's the company's plan. It's the plan that the management team and we and everybody agrees on. The great thing about the businesses we invest in, because of their age and stage, if we get the macro right, there are so many ways we can create value, and the most important one is simply by making the company bigger and better. And there are multiple ways we can make these companies bigger. So, because of 150 companies, because various stages, because of the platform we have, because operating partners who are dedicated to working with these types of businesses, we have the ability to help them to shape and create that future. And if we do, we're going to get paid for it. I'll just give you an example. It's very often the case that by the time we invest in the business, it has a fully commercialized product. It's doing pretty well. It's growing. But our analysis says that based on a CAC ratio, based on the ability to hire more salespeople, they have very much under-exercised the growth potential of the business. So we're going to hire salespeople and create the discipline to do that. It's very possible that they're operating in an attractive space, but with a limited TAM. So we're going to look at adjacencies, and we have the capital to do add-ons. So the company we sell may have a much larger TAM than the company we bought. And these, if we do it right, these directly translate into value creation for our investors.
Terrific. So let's talk AI for a moment. Maybe start with, here at Riverside, how you're using AI, how it's impacting the firm, and what you think the future of that use might be.
Yeah. Let me start with my highest level view of AI, which is won't be a shock to anybody, but stating the obvious is often my role. We think AI is kind of like electricity. I mean, when electricity came along, nobody really understood what was going to happen. But looking back in retrospect, you wouldn't have said to an owner of a business, do you think electricity is going to change your business? I mean, it changed every business. It will change the most boring businesses, less so, and the most exciting businesses more so, but every business will be impacted. So Riverside is a business. We're not the biggest business in the world, but we have 350 people spread around in 15 offices and a dozen countries and all the things that a business has. So AI should make us much more productive. It should make us much better at what we do. Some of that maybe is a little bit, sounds a little bit not very sexy, if you will, but we write a lot of investment memos. Sure. We read a lot of confidential information memorandums. I think I hear AI is pretty good at stuff like that, and we're starting to figure out how to use that as a way, not to replace our folks per se, but just like 15 years ago when we started to send some of the less interesting work we did to India. AI doesn't get bored. It doesn't mind menial work. It is very efficient. It
doesn't sleep.
It doesn't sleep. So let's try to push as much of that work there and allow our folks to do the part of the job which is really the highest value add and the most interesting, which is building relationships based on trust and communication and thinking about these bigger macro issues that we talked about and getting that right. So that's what we're focused on within Riverside, just ourselves. The higher order work for us, if you will then also be to make sure that we are properly reflecting the potential of AI, for good or bad, in our investment decisions. So every time we look at a company, we have criteria now where we ask ourselves, will this company, at a most fundamental level, will this company be helped or hurt by AI?
Right.
And we've passed on numerous opportunities where we said it's a good business, but we're just not willing to take that risk.
Yeah. How about those companies that are in the middle, right? So these are not businesses that are AI platforms, that are even technology first, but they're not businesses that are going to be crushed by AI. But they might be crushed by competitors that are using AI better than them. So as you look to both your existing portfolio and the companies that you're thinking and hoping will have the flexibility, speed to be able to change thinking, take on new systems, redo certain ways that the business operates, how much of a filter is that for your decisions going forward?
It's an important filter. Let me say at the outset, while we do a lot with software, I do not consider Riverside to be like a technology-forward investor. I mean, I know what some others are doing, and it's not my skill set, it's not my history, and it's not how the organization has evolved over 35 years. So I don't, many of the companies we're investing in fall in that middle group, that cohort that you're describing. So it's very much where we operate. And I guess the challenge is to figure out whether AI is going to be a friend or a foe. I'm optimistic that it's going to be much more a friend than a foe, but I guess what it's forcing us to do is to think about what are the criteria that will make it more friendly. I think one of them is if the company we're investing in is the expert. Most of what we do in the software world, what I would describe as sort of niche vertical software. So it's solving a pain point in an industry, if you will. And if the company we own or we're looking at investing in is the leader, is the most knowledgeable, has the most customers today, is the best equipped to provide solutions, then whether they're a human sitting in Cleveland or a human sitting in India or a AI-driven platform is creating the programming, I think that company is going to be the winner. I would say that we are careful about businesses which are fully evolved in a model that is pre-AI, if you will. I mean, honestly, AI has existed for many more years than people think, but you know what I mean, pre the attention it has today, and is going to really struggle to change its business model because it has lots of people, maybe well-paid people, who are doing something that a competitor that doesn't have that legacy is actually going to be an advantage. So, once upon a time, we looked a lot at whether the business is sort of digitally native. And I think there's an analogy here for AI. So you want to be careful if the business is, if they're simply saying, well, we've got a great business and we've got all of this, and we're just going to graft AI onto it. They're probably not going to win relative to a new firm that's starting up somewhere that maybe you're investing in that has a AI native solution that's going to displace them.
Okay. So last question. Looking for that uber kernel of wisdom here across all the years, 1,000 transactions. You've seen a lot of companies that have probably had every bit of success and more success than you would have imagined, and some that fell short for various reasons. So curious if you can help us understand the key common denominators and the extent to which it's things like the horse, the jockey, the market size, the timing, or even luck, the role of luck in these things.
Yeah, I often think about how much luck or timing, which kind of can be the same thing, have mattered. Riverside's been an enormous beneficiary of luck and timing. But it's very hard to get that right as an objective criteria. The jockey always matters. My mentor once upon a time was Mort Mandel at what was Premier and now our great friends at Parkwood. And he wrote a book, It's All About Who, and the people always matter, but nobody gets the people right all the time. They just keep working to get better and better at it. The industry, the macro that I've referred to a few times, getting that right, a great company can be a very good investment in a not great industry. But now we're back to needing luck and the great jockey.
Sure.
A okay company in the right industry can be a very good investment, even if you don't get everything else right. So Jonathan Gray at Blackstone talks a lot about the neighborhood. What neighborhood are we investing in? Literally in real estate, but figuratively in any investment. We need to get the neighborhood right at Riverside, so that even if we aren't perfect on the jockey or the horse or any other aspect, we still make money. 36 years later, 1,000+ investments, and I'm still humbled, literally humbled by how often I get it wrong. It's very hard to do.
Yeah, well, I can relate to that, and that's terrific, a great place to end it. Stewart, I thank you very much for your time, for sharing your perspective with us here, and certainly want to thank all of the companies and employees of these portfolio companies that are working every day trying to create value for themselves, their companies, and all of us as investors. And we appreciate everyone's time in joining us for the annual meeting this year, and wish everyone a terrific 2025.